Hello student. Today I would like to discuss about receivable. So previously we already talked about bank reconciliation and general journal in merchandising business. Okay, let's start. So today's material has the relation with general journal in merchandising business. So in general journal, when you are making sales both in merchandising business or in service business, you will get account receivable. Okay, now this receivable will be we will discuss about receivable further. I already put all of this PowerPoint and assignment related to the account receivable on the classroom, so you can have an access now. Okay, there are three types of receivable. First, account receivable. Second is not receivable, and last one is other receivable. Let's start from account receivable. So in account receivable, usually it is used for selling merchandise or services on credit and normally expected to be collected in a relatively short period. Okay, sometimes you miss a match between account receivable and not receivable. Not receivable is normally we use it to grant credit on the basis of a formal instrument of credit called a promissory note. The difference between account receivable and not receivable is normally not receivable will have longer period than account receivable. So if you're already aware that account receivable normally will last for 30 days or a month, while not receivable normally we can use this mechanism for all of receivable less than a year, but normally it's around 3 to 6 months. Okay. The last one is other receivable. It include interest receivable, tax receivable, and receivable from officer and employees. For this week, we only focus on account receivable and not receivable. Okay, I can skip this. Okay. Uncollectible receivable. Companies often sell their receivable to other companies. So a company can sell their receivable. This transaction is called factoring the receivable. The buyer of the receivable is called a factor. And how does the mechanism of factor? Okay, if you can see here, the gentleman here is a seller while the ladies here is a buyer. The seller here agreed to sell the receivable of $500. So he has a receivable of $500 and he wants to sell it to these ladies. He will sell it for 450, of course lower than the amount of receivable itself. In return, he will get $450 in cash. Okay, this lady here is the buyer of that receivable. The buyer agreed to get that receivable of $500 and pay to the seller in cash. Later, buyer here will get, okay, uh, she has to pay 450 to the seller, but later she will get $500, but not today. She will get this $500 if the debtor of that receivable here pay their debt. So this gentleman will get cash immediately, while but he has to lowering the amount of the receivable, while this lady here is the buyer where she will get $500 later. Okay, by sacrificing $450 now. Sorry. There are two types of method in uncollectible receivable. The first one is the allowance method and the second one is direct method. In allowance method, you are using estimation. So the estimation can be done by two way. The first one is by estimating based on the percentage of sales. The second way is estimate based on analysis of receivable. We will learn how to do it both of this estimation. And the last one is by using direct method. In direct method, we are not using any estimation. Okay, so the estimation only applied on the allowance method. Let's start the allowance method. What is allowance method? Okay, this method is consistent with the matching principle. So in allowance method, management makes an estimate each year of the portion of account receivable that may not be collectible. Okay, so here, the estimation here, they are creating estimation here based on prediction. Normally, they will make calculation based on past experience. Once they get the number, they will make journal as it is. Uncollectible account expense is on debit and credit is allowance for the full account. The actual account that prove to be uncollectible are debited to allowance for the full account and credited to account receivable. Okay, let's see the example here. For example, on December 31st, Cynthia Richard estimates that a total of $4,000 of the 105th thousand balance in her company account receivable will eventually be uncollectible. So $4,000 here, based on her prediction, is not uncollectible. That's why Cynthia needs to make journal. The journal will be debit is uncollectible account expense, or you can say it as bad debt expense. Okay, for $4,000. The credit side will be allowance for the full account $4,000. Okay, because the 105 here is cannot be collected all of it, because there are 4,000 here that estimate will not be collected. Therefore, the balance of 101,000 is the balance that expected to be collected. This balance is called the net realizable value, or NRV. The adjusting entry will reduce receivable to the NRV and matches uncollectible expenses with the revenue. What does it mean? Okay, we can see from the example here. Imagine that the allowance here is a bucket. So, you can fill the bucket by using adjusting entry and fill the allowance. It's just like you're saving in the bucket. The adjusting you create here will be adding the allowance of your balance. Okay, your balance allowance will be increasing. Okay. Now, when you are using your allowance, your money or your bucket will be decreasing. So the writing of account will empty your bucket. Okay, let's start with the example starting on January 21st. John Parker's account totaling 610 is considered to be uncollectible. When it's considered to be uncollectible, it means in the real transaction, this amount cannot be collected. So they have to write off this balance. How to write it off? To write it off, normally we will put cash here if we receive the account receivable. But since we write off the uncollectible account, here on debit side, we put as allowance for the full account. On the credit side, the account receivable will decrease. But it's not because it is being paid, but it's because we write it off and we put the allowance on the debit side. What if the John Parker's company here can pay their debt? So if he can pay the debt, it means we have to flip the journal. So the journal will be account receivable to allowance. You have to create this journal if the things that we estimate here considered to be uncollectible, but eventually it can be collected. So we flip the journal account receivable to allowance for the full account. After he paid to us, we can create journal cash debit and credit is account receivable. Okay. We will discuss it again. If you still have any question, we can discuss it on the assignment. Okay. Okay. This is the first way to predict or to estimate the amount of uncollectible account expense. The first way is estimate based on a percentage of sales. If credit sales for the period are, this is the example, if credit sales for the period are 300,000 and it is estimated that 1% will be uncollectible, the uncollectible account expense is 300,000 multiplied by up 1%, it becomes $3,000. The journal will be uncollectible account expense on debit and allowance for the full accounts on credit. That's all. Okay, now the second way is more or a bit complicated than the first method. So the estimate will be based on the analysis of receivable. In order to do this, we have to use the account receivable aging and uncollectible table. Okay.